Scott, a relatively new company, you guys IPO'd in 2018. I want you to just kind of introduce to our viewers what you guys do and where you sit along the process of taking information from consumers and bringing it to institutions that want that data.
Well, first of all, thanks for having me today. I appreciate it. So what Cardlytics is we are a digital marketing platform. And where we're different, instead of signing up a bunch of customers to market to through our platform, we have partnered with banks, large and small, across the U.S. to access or bring marketing to customers through the bank's digital channels, online banking, mobile banking, in the terms of cashback offers. So while customers don't know Cardlytics, they know Bank of America deals at Bank of America or Chase offers with Chase and many other banks. And then the second asset that we have with our bank partners is we process customers' transactions to bring them the marketing or the cashback offers that are most relevant to them based on how they've shopped in the past. And then we also process the transaction data to measure the effectiveness of the marketing so our advertisers know the return that they're getting on their advertising down to the penny.
All right, and in the latest quarter that you guys reported, you did almost 50 million revenue, 37% climb on an annual basis. You're still not generating earnings, but the losses were smaller than some of the expectations. But then again, not a lot of analysts have covered you guys yet, so I just kind of want to give the perspective here. So tell me, the revenue growth story is really what is driving the excitement around this right now. Is this about getting new clients and new partnerships, or is it about demonstrating value and getting paid more per the clients you already have?
Yeah, so the past couple of years, we have made significant investments to scale up our infrastructure to bring on Chase, and then Q4 this year, Wells Fargo. In this quarter, we actually passed 120 million monthly active users. The reason that's important is the clients, the people that pay us, our advertisers. We now have scale comparable to the other very large digital channels. And what we're finding is that advertisers now, with this new scale, are saying, okay, this is interesting. It's an alternative to the ways I advertise today, with much better ability to target, much better measurability. We're a brand safe channel that drives people into stores and to online. So we think our growth is really driven by excitement in the advertising community around having a new digital platform available.
So help me with the monthly average users. If we bring up, we've actually got the data again, guys, in control. If we bring that up, because I just want to put this in perspective, because again, the revenue growth big, the EPS loss smaller than it was a year ago, so making progress on that front. But it looks like the average revenue per user did drop on a year-over-year basis. What's behind that?
Yep. So compared to last year, we grew our monthly average users 104%. So we were at 59 million in Q2 of last year. We just broke 120 million this year, and we are projecting to be up to 150 million by the end of the year. So while we've grown advertising investments significantly, we've grown MAUs even faster. And so now what we're working hard to do is to go and to monetize those MAUs, really unlock the value of it. And we're in the very, very early days of doing that.
Now, were there previous clients that then did not have this, were their contracts renewed at a lower price? I just want to figure out how, even with the growth for monthly active users, the revenue per user is going down. Are you just bringing on clients at maybe a lower price point and are planning on upping that price point going forward?
Yeah, no, it really wasn't a function of pricing. It was a function of, let's say we had a client that was spending $3 million when we had 59 million users. We went to them and said, we want you to increase your investment to 6 million. Maybe they said, this year we only have 4.5.
Okay.
Because they have other types of marketing activities they're doing. And so the trick is growing the advertising budgets and adding new advertising budgets to keep up with the rapid growth we have in MAUs. But it's not a pricing function. We deliver great return for our channel. For every dollar an advertiser spends, we bring them $4 to $5 of truly incremental revenue.
Okay, now this gets to my other big question, which is about who you compete with in this space. Because when you say, well, let's say a client says, well, we want to pay for your services, but we've also got marketing and advertising tools through these other areas. We talk about a company like the Trade Desk or previously public App Nexus as well, or sorry, private company, but those are more kind of auction platforms for connecting advertisers. Where do you sit within that competitive space?
Yep. We directly compete for advertising dollars. So the way our advertisers are looking at us relative to the other choices they're trying to make, first of all, of course, they're thinking about what marketing objectives are they trying to achieve. What we are really good at is bringing new customers in because we know who's shopping at an advertiser today and who's not. So we can find the new high potential customers, and then working with those customers to get them to become repeat customers. So we compete for ad dollars. What makes us a very unique digital marketing channel is we drive people into stores, not just to online, not just to websites. And one of the reasons that's really important is in a world where people worry so much about omni-channel marketing, what we understand, what we learned from our data, is when a customer spends both with you in brick and mortar, but also online, they spend over twice as much with a retailer than they do if they were shopping in a single channel alone. We're very good at developing those omni-channel relationships.
Okay, so when we look at the sort of incremental growth going forward, it sounds like these expenses on either salespeople or programmers that are, writing the basic kind of function when you guys are connecting those financial institutions with the opportunities to the customers. I imagine there's software behind that. What's your biggest expense going forward?
Yeah, so we've been talking pretty publicly that in the back half of 2019, you're going to start to see the benefits of our fixed cost business. So as we will continue to grow revenues, we will be growing OpEx at a significantly lower rate. And that's where you'll see that, okay, we've made these investments to stand up Wells and Chase and Bank of America. Those investments are now in place. And as we grow revenues to take advantage of those, you'll see the profitability begin to emerge in the business.
Okay, and then lastly, I saw that you recently had a share offering. Last month, you guys said you're going to offer 4 million shares. What is the plan going forward for shareholder activity? Do you see that being enough runway for what you need to do, or are you willing to tap into the stock again down the road?
Yeah, so we filed that shelf statement basically to give ourselves options. We looked at it as just good governance. The company's well capitalized now, but of course we're always out there thinking about when and how to leverage the capital markets, both to simply have a strong balance sheet, but also to position ourselves for other investments, M&A, whatever we need to do going forward.